Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video, we're talking about a new stock to the channel and one that I've had a bunch of people ask me to look into. The stock we're talking about today is Citius Pharmaceuticals, which trades on the Nasdaq under the ticker CTXR. In this video, we will cover all the key things which you need to know about this stock, why people are getting excited about it, what the main risks are with an investment into Citius, and then finally we'll touch on what I'm doing and how I'm going to play this opportunity. In this video, we're going to cover a load of things which nobody else is talking about for this stock, so this is not one you want to miss out on. Now on this channel, over the next couple of weeks, we're going to be talking about a bunch of new stocks which we've not discussed on the channel before, so make sure you keep an eye out for those if you are interested in that kind of video as well, because we are going to be uploading slightly more frequently than we have been doing over the last few weeks. As well as that, please let me know in the comments below if you want to see a specific stock talked about on this channel. I always find that a really helpful way to have new stocks put on my radar and my watch list, so thank you for those who've done that. Please like the video, subscribe to the channel and check out the Patreon for the private Discord group. All of that is massively helpful to the channel and it's really appreciated. As always, whilst my full-time office-based job is investing, I'm not a financial advisor and this video is purely for educational and entertainment purposes only, but let's get straight into it. So, what does Citius Pharmaceuticals do? Well, Citius is a late-stage biopharmaceutical company focused on the development and commercialization of critical care products. They have a pipeline of 5 products focused on anti-infectives, oncology and stem cell therapy, and 3 of these 5 products will be the first and only treatments for the specific ailments that they're treating that are non-surgical. Well, what does that mean in simple terms? Well, Citius has a pipeline of 5 medical innovations, be it drugs or therapies, which are at different stages of testing and have different timelines for approval by the FDA. As with any drug development company, there is no guarantee that these products pass the various stages of approval and testing and ultimately get FDA approval to be a mass-produced drug. The important thing to remember at this point in time is that Citius has no products which are FDA approved, and it has no drugs which it is creating a revenue from. Now we'll come back to this shortly and why it's really important as a consideration. Now I'm not going to go into the specifics of each drug and its benefits here, however this chart does summarise it quite nicely. Either pause the video if you want to check it out in more detail, or the chart is also on their website. It shows the various stages of the 5 drugs that they're currently working on, what their use case is, and what the potential addressable market size is. The one which is probably most exciting is Mino-Lok. Now I'm not going to go into the medical specifics here as I'm not a doctor. However, in very simplistic terms, it is a medical treatment which, if approved by the FDA, will replace what is currently a process which is treated by risky and challenging surgery. The clinical outcome here is clearly superior for patients, and it drives increased efficiency for medical practitioners. It also has a pretty meaningful market size at just less than $2 billion. Mino-Lok is currently in phase 3 trials. This is the final, most rigorous testing stage, and is producing pretty promising results so far. In fact, this is the main reason why there was a meaningful run-up in the stock price in June of this year. Many investors believe that the FDA was going to grant early approval and not require the company to finish the trials on that drug. In the month of May, Citius was trading around $2.20 a share, but as this expectation and rumours disseminated within the market, the stock rallied and peaked at just under $4.25, or around a 94% increase. The rumours and expectations did not materialise, and the stock price fell back down to its previous trading range. Now this has 3 important elements to consider. Firstly, it's an indication of what potential impact the FDA approval will ultimately have on the stock price, if it is successful in its trials and it does get approved. And again, we'll come back to this. However, it also provides an indication for the sensitivity of the stock to news, which we can use to determine an optimal entry and exit strategy for us. Thirdly and finally, the early completion of phase 3 clinical trials is a very rare occurrence, so the fact that this did not happen is not really something which investors should be meaningfully concerned by. It does feel as though perhaps there was a degree of market overreaction in the sell-off, and that Citius was the beneficiary of some increased focus on pharma penny stocks occurring at this same point in time. Now, currently, Citius is expecting to file Mino-Lok as a new drug in 2022. However, don't be surprised if this term is being used somewhat creatively, and that we see this being a Q4 2022 development. Also, in turn, this means that they won't be generating revenues until 2023 at the earliest. Then comes the interesting decision. Do the management team then sell Mino-Lok to maximise value, or do they seek to maximise the product potential themselves? Currently, Citius has a market capitalisation of around $285 million and is well capitalised with around $100 million of cash on its balance sheet. So, what is the investment thesis for Citius? Well, we have covered this off somewhat already, but the investment thesis here is the opportunity to invest in a late-stage pharma development company, which has an exciting pipeline of drug development opportunities, which have a compelling commercial proposition and are delivering very positive results across various stages of clinical trials. The plan here is that a number of these drugs ultimately receive FDA approval and become the leading treatment for the various ailments they're designed to treat. The management team are good, and they have delivered on the strategy effectively to date. It's important to remember that this is a pre-revenue company. As a result, they're not generating any money to pay the bills, pay the salaries and keep the lights on, and they have resorted historically, and are likely to continue to, issuing equity in order to cover those costs, which is clearly dilutive for shareholder value. The more this happens, the worse it is for investors. But clearly, should they deliver on the strategy and develop commercially viable products, then the risk that investors will have taken here will have paid off. Now, we will come back to this point in a moment because it is really important to understand. This dynamic also means that investors can look at this in a number of ways. Is it a medium-term position where one waits to see the potential outcome of the clinical trials, or instead is it a longer-term play waiting for those drugs to potentially become commercially viable and the leading treatment? This is something which is important for investors to consider, as it impacts both time horizons and potential return considerations. So, what are the main risks with an investment into Citius Pharmaceuticals? I'm going to keep this fairly simple and brief because it's pretty binary, but important. The main risk here is that the company fails on its mission to produce any products which are commercially viable. There is a real risk that the final stages of trials are not positive and they never receive FDA approval. As there is currently much excitement in the market about me no lock, a failure for this product to deliver, especially due to its potential market size and the addressable markets it's seeking to attack, this could lead to significant downward pressure on the stock price. Yes, based on results so far, it would be a bit of a surprise, but investors do need to be aware that this is a potential risk and keep their eyes open to this when investing in the company. As well as the risk of it happening or not, there's also a timing risk here. Through factors outside of the control of the company, they may face difficulties in delivering stated timelines. Now, this is particularly important if you're looking to play this with an option strategy, but again, we will come on to this in a moment. Now, the next risk is focused around the fact that they're a pre-revenue company. This means they don't have any meaningful cash inflows, offsetting the expenses that are incurred by the business, and they are ultimately burning cash. To date, the company has issued equity. In other words, it's sold more shares to investors to raise the money they need to keep the company afloat and to keep the lights on. This is dilutive for shareholders, and so something which long-term investors need to remember and need to keep in mind. There will come a point in time where the company needs to raise more shares again to raise capital and to cover the expenses that the business has been generating. In the short term, this is probably not a huge issue as the company is well capitalised with over $100 million in cash, but this is something that will happen again within the company. It's not exclusive to Citius, nor other late-stage drug discovery companies. Any company, regardless of the sector that it operates in, if it's pre-revenue and is burning cash, faces the same risk. Whether it's an EV company, a biotech stock, a mining exploration company, they all face this same risk. In the case of Citius, this is mitigated for a period of time due to that decent level of cash on the balance sheet to cover the cash burn for a period of time. However, one thing to keep in mind is that the company has already stated that its operating costs will increase, which in turn does increase its cash burn rate, and so this is important to remember. Ultimately, long-term investors should expect another stock issuance in the near future, but that is the risk that every investor in this company has to take in order to be compensated for the potential upside in the stock. In addition to all of this, there's also the broader macro factors which are impacting the overall return profile for risk assets and stocks, specifically upcoming tapering and inflation concerns and the impact this will have on equity markets in general. So, what am I doing here? Well, personally, I think this is an interesting one, but for me, I'm going to play this over a short period of time rather than a longer one. I'm building a small position in the company, cognizant of the importance of portfolio management here. Given the risk profile of the business, its scale and potential return profile, I'm taking a small position in the stock and will be looking at the upcoming catalyst of the future me-no-lock developments and the news coming from those trials as my exit point. So ultimately I see this as a 6 to 12 month play for me. I cover portfolio and risk management on the Patreon-only video series, so check that out if you're interested in learning more and learning the best practice towards consistent, strong, long-term returns in your stock portfolio. Yes, there is the risk of bad news and delays to the timeline that may have a significant impact on the stock price, but that is something which I'll monitor closely and keep an eye on, and it's a risk I'm cognizant of in opening my position in Citius. In some situations, some investors may see an interesting play of buying out of the money options and using this to capitalise on the opportunity. While in situations where the catalyst date is more set in stone, that's something which can make a lot of sense. In this scenario, I would discourage such a strategy. Given the potential slippage and uncertainty over timing, this could complicate such an approach. Indeed, had you taken that approach 6 months ago, if very short-term options, then perhaps they could have already expired or be close to expiry and basically be worthless. At least when you own the underlying stock, you don't face that same risk and the delays are not as problematic. Two other factors which I also take confidence in are the fact that management are also increasing their position in the stock. Clearly, those are the ones who are most informed about the potential the business has and how it's developing, so seeing them increase their position is always positive news. When I see the reverse, and especially if it's meaningful sums of money, I always treat that as a red flag. Additionally, there's some really serious institutional investors in the shareholder base, including BlackRock, Vanguard, State Street and Northern Trust, and again, that's always a great thing to see in validating our own thesis here. Anyway, that's it for today. I hope you enjoyed the video. If you did, please do all that good stuff, like, subscribe, check out the Patreon for other exclusive investing related content. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.